Is there an upcoming housing crisis? Is there an upcoming housing? I don't want no smoke with nobody, fam. I just want to have a good time. I want to be entertaining. I want to give you the information that's being out there and break it down from my perspective. All right? I don't want no problems. I don't want no problems at all. You know what I'm saying? I'm chilling. Is there an upcoming housing crisis? Is there an upcoming housing crisis? I have my own opinion of it, but let's hear what the experts got to say. Make sure y'all hit a like for the YouTube algorithm, subscribe to the channel, and turn on your notifications.
For real estate reality check, let's bring in our A-list panel to kick it off. Redfin Chief Economist Daryl Fairweather.
Can y'all hear that? It is raining like crazy. It is raining like crazy here. I'm sure y'all can't hear it. The microphone probably not picking it up, but it is raining like crazy here, man. It is insane. And the likes is low. Hold on. Apparently, we need to go over to a Teej commercial. It's almost 2,000 people in here watching this, and the likes is at 642. What are we doing? Teej Hanley, 30% off your first order plus a free gift. We got to go to the Teej. Are we going to the Teej commercial, the throwback Teej commercial? Or y'all going to get the likes up? All right, y'all said y'all going to get the likes up. Let's continue. Is there an upcoming housing crisis? Let's hear what the experts got to say.
For real estate reality check, let's bring in our A-list panel to kick it off. Redfin Chief Economist Daryl Fairweather, Reventure Consulting CEO Nick Jurley, and Crescent Capital Chief Investment Officer Jack Ablin. Jack, I'm going
to be reading those super chats shortly. Thank you for continuing to hold me down.
Start with you. You actually just randomly, we had already planned to do this. I get this note from you. We asked you to come on not that long ago. Thanks very much. Using your math and using rates and whatever, you think that the median price of a home should be over $100,000.
Is it me or do that dude look like Jerry Springer on the right-hand side?
Less than it is right now.
Yes, and it's a pretty simple math, Brian.
That dude looked just like Jerry Springer.
And all we're doing is we're taking median incomes, which we're calculating at $77,000 roughly per year. And again, that's been going up over the last couple of years. So we want to take that into consideration.
He said the median income is $77,000. Is that household income?
Calculating a mortgage rate of about 7.5%. And then we assume that 25% of the income goes to a monthly mortgage payment. We kind of gross that up and then add another 20% for a down payment. We come up with $283,000. That's substantially below the 400 plus thousand that you're showing on the screen. So I don't expect we're going to see an immediate 31% crash.
Wow.
Because like you said, those existing homeowners who have low mortgage rates are just going to stay put.
Yeah, and Daryl.
So this is what he's basically saying, right? And it's relevant. It's relevant to this conversation. He's saying, listen, we have an affordability crisis because the average household income, the median household income is $77,000. So that means that when you take the top and the bottom and then the average, right? And then two people may be working, maybe one person is working, well, maybe one person is not. I know everybody's saying that they out here making $100,000. I don't know where, right? They're saying the median household income is $77,000. And based off of that and giving a 20% down payment, right? Because I know a lot of y'all like to do the 3.5%, but you're not really taking into account the fact that you're going to be paying more interest, that you're also going to have to pay PMI, which is private mortgage insurance, right? That increases the value or the amount that you're paying. And you also not taking into account a lot of y'all are paying HOA fees, the maintenance, all of this other type of stuff, property taxes, right? You're not taking that into account when we're talking about affordability. Okay, so I'm going to be reading that super chat shortly. So when you talk about this, he's saying that based off of what the average or the median household income and a 20% down payment, we're calculating it actually to be a little bit above $250,000, a little bit above $250,000, which is a drastic difference from what the average household or the average purchase price of a home is, which is above $400,000.
I want to be clear, the median home price has come down off its peak of a couple of months ago. I think it was around 430 or 440. So the trend is down. You know, I want you to comment on what Jack just said, but also here's what's bonkers. It doesn't seem to matter. If you put a decent house for sale on the market, I talked to a lot of realtors, they sell in like 3 days.
Yeah, I think what should be the right price is very different from what actually is the price right now. We have a real lack of supply, a lack of supply that has been going on for at least 5 years, but during the pandemic became extremely acute because people snatched up all the homes and now they don't want to sell anymore. About a third of homes for sale right now are new construction because there are so few existing homes on the market. And since new construction is doing quite well right now, at least, amidst these high rates, I can hope that there will be more inventory down the line. But for the time being, those prices are probably going to stay put high. Homeowners don't have a real reason to sell.
No.
So here's the key. Right? He's basically saying if you take that $77,000 median, the affordability of a person that makes $77,000 a year is really about $250,000 home, right? But the average home is selling for over $400,000 across the nation. So then how do you then justify the idea that homes are selling for $400,000 when the average person can only afford a home that's really about $250,000? Well, therein lies your dilemma, right? Because what's happening is he's also factoring in, and this is why we have to make sure that we take in all of the factors and we take in all of the context. He's factoring in a 7% interest rate. Homes were much cheaper 2 years ago than they are today, right? Meaning that the price that you're paying in your monthly payment, not the price of the home, but the monthly payment is based off of an interest rate that was significantly cheaper, which is why most people are not selling their homes right now. People are not selling their homes not because they don't think that their home is worth it or they don't want to move or whatever. They're staying put because they know that they're going to have to use that same money in order to buy another home, and they can't afford the interest rate that they're going to be paying because most people factor in what their payment is, not necessarily how much they're going to be paying long term for the home. Remember, people always buy things based off of what their payment is. They don't factor in how much they're going to be paying for that home over a period of time. The reason why there will never be a housing crash in the immediate future, I do not believe that there's going to be a housing crash within the next year, the next 2 years, so on and so forth, because people are staying put in their homes unless you give them a really, really good reason to move. They're staying put in their homes because they don't want to be paying that 7% interest rate. They'd rather pay the 2.5% that they got in 2021. Let's continue.
In fact, they not only not have a reason to sell, Nick, they've got an active reason not to sell, which is, maybe I'm sitting on a bunch of equity, I'll make a fortune, but unless I'm moving to like Equatorial Guinea, I'm going to have to buy a house somewhere else, and I'm going to end up paying 7%.
Literally, I just said that.
Do you see a crash coming?
And, that's a great point, Brian. A lot of people
No, there will not be a crash.
However, here's the thing. There's 100 million.
There may be a correction, but as long as you have a seller's market in which homes are moving in roughly 3 days from hitting the market, meaning that there's an excessive amount of people that's willing to buy homes, but they don't have the inventory in order to support it, you will not see a crash. You will continue to see prices go up, even with the 7% interest rate. That's just my personal opinion.
In single-family homes in America, the inventory on the market's less than 1 million. So all we need actually in America to see inventory increase substantially is a little bit of distress in the housing market. And
3% back in 2020, 7% today. That's a big difference. Remember, one of the reasons why they increased interest rates is that they justified it by saying that they wanted to tamp down inflation. So they've been raising the rates.
One area I'm seeing that distress right now is with investors. Lots of investors who bought during the pandemic, whether they be for long-term rentals or Airbnbs, their properties are sitting vacant right now.
And therein lies your dilemma, is that the Airbnb people, the people that look to make an investment, but they can't necessarily get a return on that investment, those are the ones that's going to be under duress. It's not the people that's living in the homes, right? Because we still have a record low unemployment rate. It's the people that went into it and y'all let all of these gurus sell y'all on starting the Airbnb, but you truly didn't understand the cost of doing business. And so you see a lot of people's homes are sitting vacant. Nobody is vacationing because they can't really afford to. Credit cards is out of control, past over $1 trillion. Student loan debts is about to kick back in. Seasons are changing, so whatever it is that you didn't make money on in the summer, you're not going to make money on in the winter. And so as a result, the people that is feeling the pressure is the Airbnb owners and the people that investing in houses in order to make money, but they don't have any long-term renters. And so now they're going to have to either A, adjust so that they can make that payment, or B, they're going to have to sell their home. And that's the thing that's going to put more inventory, allegedly, into the marketplace.
The rent is going down as their cost of debt is going up. So a lot of these investors, like the homeowners, have said to themselves, oh, I don't need to sell just yet. But there's pressure building in the background of the housing market that I think will cause inventory to go up by quite a bit.
Nick, I'm going to go back to you, Nick, because you're making a good point. And I've been reading a lot about these Airbnbs that are now kind of being distressed sales. Can you explain a little bit more to the audience? Why would Airbnb homeowners be particularly, people who buy specifically to rent it out, they're never going to live there. Why are they being hurt more now?
It's a great question. It's all a cash flow situation and a supply situation.
Yep.
So the aggregate Airbnb demand in America is actually still pretty strong. The problem is the supply of Airbnbs, specifically in certain markets like Phoenix and Austin and Tampa, has surged out of control way more than the demand, which is now causing the revenues to go down substantially, particularly for mom and pop Airbnb owners who don't have access to all the fancy pricing tools that the...
Meaning that once you flood the market, then you have to be more competitive with other people that's in the market that's trying to compete for people that's coming in and trying to rent out homes at the same time. If you don't have a major event that's coming in, then you're going to be asked out of luck. If you don't have a major event that's coming in, then you're going to be asked out of luck. That's just the fact of the matter. Let me share with you what else is going on, because there's a tail between two markets that's happening right now.
Can we call this a rebounding market when sales are stagnating?
Hi, Lisa. Yeah, it's a good question. And we've been describing the U.S. housing market as a tale of two markets. On one hand, you have the resale market where volumes are down more than 30% still from their peak due to greater affordability challenges and a lack of inventory. On the other hand, you've got the new home market, which has been the beneficiary of that, as that lack of inventory we spoke of is actually funneling demand in towards the builders. And builders are also able to leverage their financing arms. So they've been buying down rates. So when you see someone in the resale market paying, 7.5, someone coming into the new home market is looking at 5 to 5.5. But that being said, the broader housing market, as you said, I wouldn't necessarily call it a rebound. I mean, if you look at total sales in the existing home market, which is the biggest part of the housing market and the largest source of competition for the builders, we're at about a rate of 4 million. So we're still down a long ways. I think the thing to point out is we have a situation where volumes are being depressed, but home prices are stabilizing because of that inventory situation.
So basically what they're trying to tell you, and let me just break it down from a C student's perspective, because they talk really fast, they use a lot of terms, but they're not really saying anything more than what I'm going to communicate to you right now. Because there's a lower supply of inventory, that's the thing that's sustaining housing prices, when in reality, people really can't afford what the housing market is telling them that they need to pay for these homes that they are now purchasing. Let me break it to you down from this perspective, right? During the pandemic, a lot of people ran out and they bought homes, because they were all at home and they thought that they wasn't going to be working from home. And so as a result, they bought homes outside of the markets where they were usually buy a home, or where it is that they had to live, work, and play, because they thought that they was going to be working from home forever because of the pandemic. B, interest rates were super duper low, incredibly low, stimulated by our presidents and the economy, because they wanted to keep money moving throughout the economy. And so as a result, the interest rates stayed low because we were in a pandemic. What that created was a market where everybody rushed out at the same time to go out and buy a house. During that time, if you were a home seller, if you were selling a home, you couldn't miss. People were paying $75,000, $100,000, $150,000 over asking price for homes. There were even people that were running to get into the real estate market as far as trying to be realtors at the same time. It created a gold rush which then ultimately lowered inventory. And then when you combine that with the fact that they were raising rates in order to fight off inflation, it created a situation where people are afraid to sell unless you absolutely have to. And it's creating a sustained dynamic of what home prices are going to be unless you are in a very, very bad area or you are going to get out too late, such as people that's buying homes down in Florida, especially South Florida, where they're basically at sea level and sea levels are rising on a regular basis. Homeowner insurance is absolutely being decimated down in Florida. Insurers are leaving the state in record numbers, and there's going to be a lot of people that's going to be left holding the bag down in Florida. So the dynamics of what capitalism is, it's what's creating the market that's sustaining home prices, even though the majority of people can't afford homes. They're forcing you to make an adjustment in what it is that you're doing on a regular basis in order to be able to afford these homes. You know what one of your adjustments are? Now women are seeking partners instead of husbands. Now men are seeking partners instead of wives. Because you need 2 home incomes in order to be able to survive in this current housing market, even if you're a renter. Because rental prices is going up also. And then to throw the cherry on top of that, you got institutional investors that's buying up all of the housing because it's the safest place to be able to put money in this market.